welcome. For today's interaction, I'm joined by my colleague Chirag, and we have with us Ajay Tyagi, Head of Equities at UTI AMC. Welcome, Ajay.
Yeah, hi Ruchira and hi Chirag.
So you started your journey at UTI AMC way back in 2000 as an analyst through campus placement, I believe. And did you have a brush with markets while you were studying?
No, I would say not quite a brush with markets. I would just say that during the time when I was studying, which is basically the mid to the late 90s, Indian markets had just about opened up. We had started seeing foreign investors come into the market. We had foreign brokerages that had set shop. We had seen, private sector mutual funds also registering themselves with SEBI and starting the business. So, in some sense, I would say from a very broker-driven kind of markets that we were up till the 90s or the mid 90s, we were, becoming a more professional-driven market post that. And I think, that possibly would have caught my attention and, the attention of many youngsters like me. We just realized that financial services market is about to boom in India. And maybe, that's something which caught our attention.
Can you tell us something about your starting days and what it was like to analyze stocks for the biggest fund house in the country at that point of time?
See, I would say analyzing stocks was not materially different from what we do today because, like I said, at least 3 or 4 years before I joined in the year 2000. At least 3 or 4 years before I joined, you did have a lot of professionals come into the market. So, we did have an advantage to the extent that we knew exactly what are the processes that need to be followed. Of course, those processes have been refined time and time again over the last 2.5 decades here at UTI. But the basic structure and the basic framework in terms of analyzing balance sheets, in terms of looking at companies from a medium to long-term perspective, analyzing cash flows and so on, was something we were doing back then as well. Maybe the methods were slightly different because obviously internet was not omnipresent at that time. So we used to rely a whole lot on the annual balance sheets that would come up, and we would try and put those numbers into the Excel and then analyze them. There weren't as many analyst calls as you see. I mean, I remember when I joined, the one most popular quarterly analyst call used to be conducted by Infosys. Majority companies in India would just have one physical analyst meet somewhere in Nariman Point. And very, very few, if at all, there would be companies doing a quarterly teleconference, which has now become par for the course. So I would say the methods were slightly different. The access to information was not as free-flowing and as easy as it is today. But the framework, I don't think, has been materially different between now and what it used to be 24 years back. Yeah.
Okay, so when did you really start managing funds, and how has your work as an analyst helped you in fund management?
So let me take the second part of your question first. I would say it is imperative for any fund manager to actually be an analyst for some time before he or she starts to manage money. Because you see, the basic framework gets clear to you only when, as an analyst, you've been crunching numbers, you've been trying to figure out what's the value of a company using different techniques. You've been analyzing balance sheets. So I think the basic groundwork is extremely essential to become a successful investor, to become a successful fund manager, and no better training than being an analyst before moving on eventually to being an investor. So that's the second part of your question. As far as when did I finally start managing money, this was basically around the financial crisis. So 2008 is when I moved over from the role of an analyst to that of a fund manager.
Mr. Tyagi, you have been with the UTI for over 2 decades. What made you stick to one fund house, and how have the things progressed for you in terms of career enrichment at UTI?
So I think as far as what made me stay back, it was basically this question which I would always ask myself, which I still ask myself, that what would be the reason for me to leave UTI and go elsewhere? I just felt that whether I'm managing money at UTI or managing money at HDFC or any other fund house for that matter, it ultimately boils down to looking at those set of companies, following the framework that I have, and basically taking decisions. So in terms of getting independence, getting the right kind of resources, getting the right kind of team, we've always been blessed here at UTI. And like I said, ultimately, if it's really managing money, sitting in UTI or sitting in any other mutual fund didn't really matter. So, but that just basically helped me, stay focused, helped me stay put here, because I finally realized that there is nothing that I can't do sitting here, which possibly I can do sitting elsewhere. So that's, I think, the short answer to your question. There have obviously been a sequence of events over the last 2.5 decades. But to cut the long story short, we just felt that UTI is the best platform to learn and grow. And that continues to be the case even today. I just walk up to office every morning thinking that, I'll use the collective wisdom of the team to gain more insights about different sectors and different businesses. And that just keeps us going.
All right. And when it comes to investing, can you share who's been your inspiration?
I would say my biggest inspiration has been Warren Buffett. I would be lying if I were to, take 5 more very, very interesting topical names today. But I would say that it was his very simple framework that resonated with me right from my very, very early days. I started reading his newsletters almost immediately after joining UTI. And the common message, I would say, that he had all through his newsletters of the 1970s till date was that you need to keep the equation very simple. You need to be an investor who thinks about the business rather than thinking about the markets. Your thinking has to be business-like rather than double guessing where the markets would be should you move money from one sector to the other. And I think that is something I just felt very, very comfortable doing. Maybe it just was highly synchronized with my own personality. So I think he's been the biggest influence on my thinking per se. I would say that there was also another great investor, Philip Fisher. And in fact, Warren Buffett himself claims that he was influenced by Philip Fisher in the later part of his career. And Philip Fisher's own philosophy was, about buying great companies, holding on to them, forever, and acting on them very, very, seldomly, only when there was a massive or a material change that would have happened in the business. So I think, predominantly Warren Buffett, to some extent Philip Fisher. Yeah.
How will you define yourself as an investor, and what kind of stock or situation excites you?
So Chirag, I would say that my investment philosophy is very, very simple. I just believe in buying high quality businesses that are creating strong economic value and which have very strong return on capital, which is persistent. I know that you would immediately rebut this by saying that, look, all fund managers ultimately think that what they buy is high quality. Nobody is buying trash or nobody is buying junk. But I exercise a very objective definition to really come to the conclusion whether the investment or the business that I'm looking at is high quality or not. And that's basically looking at the return on capital versus the cost of capital through the cycle. So there's no point looking at things at a point of time in the cycle, because you look at a point of time, even a lousy business like steel can give you very high ROCs. And it indeed did happen to a lot of these commodity companies in 2021 and 22. But my approach is to look at the value that a business is creating through the cycle and in the fullness of time rather than at a particular point in time. And these businesses eventually end up being cash surplus. They end up having zero debt on the balance sheet. On the contrary, they have cash on the balance sheet. So in a way, while the first sign is that of a business generating strong ROCs, but the other ways in which this metric manifests itself is, in strong cash flow generation, low to no debt, and so on. So that's our starting point. That I would say is the hygiene factor for me. So you would never see me own a company which basically has had poor outcomes in the last 4, 5, 10 years, maybe is going through a turnaround right now. Maybe the market loves the turnaround story, but not a candidate for the kind of strategy that I have. I need consistency in terms of outcomes. The second most important thing for me is looking at the growth runway. So the business may be great, the business may be generating huge amount of value, but can it compound this value or not is the question. And you can compound the value that you are generating only when you are in an industry which basically has a very low penetration and therefore a very long growth runway in front of it. So I think these are the two, I can in a way condense the entire philosophy into these two important factors. The portfolio is constructed at the intersection of quality and growth. We want both parameters. If it's a high growth industry, maybe like the infrastructure industry, maybe like the aviation industry, we won't touch it because these industries don't have the quality attribute going for them. If it's a high quality business but lacking growth drivers, maybe like a Castrol, which is a great business, but unfortunately, with the change of the landscape that we foresee in the future, with combustion engines becoming slowly irrelevant in a marketplace where hybrids and electrics will catch center stage, the business will not be able to have the kind of compounding that it had in the 80s and the 90s and the 2000s. So yes, quality and growth both put together is what my ideal portfolio would be. And that's basically our investment philosophy in short.
And what type of stocks or situations in the market excite you?
See, there I would say there's nothing which I would say either deeply excites me or I am fearful about. So markets go through their own cycles, and even in a bull market you do find great opportunities. In a bear market you find opportunities many more times compared to a bull market because valuations are usually in your favor. But I would say that even in a bull market, and India has been in a bull market since 2014, by the way, we've just had very small corrections along the way, and these corrections may have lasted for a few months or a couple of quarters at best. So it's not to say that bull markets doesn't give you opportunities. Great businesses with great growth opportunities can have a compounding impact over decades. Even if you buy them a year or two late, it's still fine because you would still have the opportunity for the next 7 or 8 years. Yeah.
All right. Can you please share with us what kind of stock becomes a compelling buy for you, and when does that happen?
So, Ruchira, I would again take you back to my reply to the previous question. The framework that I use starts with quality, moves on to growth, and ends at the valuation. But I must say here that valuation alone never excites us. So if something is trading cheap, rather than getting excited about it, we would be skeptical about it. We would always try to ask ourselves this question: that why is it that this company has been cheap for a decade? What is it that investors have not liked in it? And the exact opposite of it, why is it that this business has always been expensive for the last 10 years? What is it that the investors love so much in this business that it trades at a massive premium to the markets and to their respective industry in general? So I would say that, what I would look for in a business will certainly be the quality attribute and the growth attribute. Valuations will follow the sequence and come in the end. Valuations never excite us. I would say even growth never excites us. I gave you the example of not getting too excited about, for instance, the infrastructure opportunity in India. Or more topical today would be the renewables opportunity in India, because I've seen this in between 2008 and 2012 when there was a massive scramble for these power stocks. When the buzzword then was, creating ultra mega power plants, UMPPs as they would call them, when people had this amazing, extrapolation of demand that India would witness in terms of energy requirements and how, supply was very scarce, with nobody bothering about whether these plants would actually be able to make respectable return on equity or not. And as it turned out, by 2013, more than half the plants actually couldn't even meet the cost of capital. Many went into restructuring, many had to just shut down. So, I see the same amount of excitement about renewables today in one shape or form. People just feel that renewables is the next buzzword. Green hydrogen is the next buzzword. While I would agree with the fact that these are sunrise industries, but not having a framework for what's the kind of return on equity that these businesses would eventually be able to make, what's the kind of balance sheet that they would be able to have, I would just stay away from them. So, I'm just, again, coming back to the core hypothesis or the core framework, which is that start with quality, go to the next step, which is growth, end the entire argument in valuation. And by which I mean,
please go ahead.
Sorry, just to wrap it up, by which I mean, if you have found a great company, high on quality, high on growth, but maybe not very attractive in terms of valuations, do wait it out for a few quarters. In my experience, I have never seen a great company not getting pounded, once in a year or sometimes even twice in a year. Even the greatest of business go through a very humbling experience on the stock exchange. That's your time to actually, pounce on it and start building exposure. So yeah, that's basically our approach.
All right. And what kind of stocks are you sure that you will never buy?
Again, let me go back to the framework, which is anything which shows me poor return on capital, anything which has historically had a very patchy track record in terms of return on capital. And when we know that even in the future, they may go through those cyclical upswings, but through the cycle would remain inferior in terms of value creation, economic value creation, we would stay away. So, we would stay away from the infrastructure sector. We would stay away from PSU banks, for instance. We would stay away from, let's say, real estate companies. We would stay away from aviation stocks. We would stay away from commodities in general, which also includes energy, which includes oil and gas, which includes metals, which includes both ferrous and non-ferrous metals. So, any sector which has had a very cyclical and a patchy track record of value creation, we would stay away, because that requires your ability to not only get in, but also get out. We want to have a framework, like I said, akin to what Warren Buffett has been practicing or Philip Fisher has been practicing, which is take many quarters or years to get excited about a business. Do your deep research as to whether this business is massively scalable over the next 10 years. And once you identify this business, be patient with the valuation, build exposure over many quarters rather than going in quickly. And once all of this is done, be patient. Just stay with it for a very long period of time. And I must end this answer by saying that the portfolio turnover ratio for UTI flexicap has been between 10 to 15% per annum for as long as you can go back. So we are indeed very patient with our businesses. Yeah.
So coming to the next thing, as you said, you don't churn the portfolio much. And we looked at the portfolio of the flexicap fund and found many positions that have been there since you started managing the fund in 2016. Don't you have any price targets that prompt you to sell a particular stock?
Great. I think, Chirag, that's a very good question. First of all, what does a portfolio turnover ratio of 10 to 15% mean? It basically means that you're holding stocks for 8 to 10 years on an average. Just the inverse of the turnover. The second part of your question was, when do we sell a stock? Do we have a price target? The price target question is very simple to answer. There is no price target that I have in mind. You see, if I had a price target, I would have sold Titan way back in 2012 or 13, by which time it had already become 3x, 4x from the initial buying price. Or I would have sold the Hevels in 2013 or 14, or Info Edge. I can keep rattling off names. Amongst the large caps, I would have sold HDFC and Kotak long time back. I bought Bajaj Finance in 2016. I could have sold Bajaj Finance by 2019. So certainly it's not the price target. We are not so naive to have a target in mind and let go of a great business. So when do we exit a stock? Our exit is the exact opposite of our entry. I think over the last 15 minutes or 10 minutes, we've discussed about our entry strategy, what kind of stocks that we like. And I've just said that we keep it simple. The business should be high growth and high quality. If any one of these things do not stay relevant for us. Or I should say, if any one of these two things is not applicable anymore, we would exit. So if a business remains high quality, but we don't see it to be a growthy business for the next 5 years, maybe it'll grow just at about 10, 11%, no more than that, we would want to exit. Or if the business, lacks its pricing power now, because of which, its margins are suffering, its profits are suffering, its cash flow generation is suffering, then it indeed would show up in inferior return on capital, inferior cash flow generation, and so on. So the industry may have remained growthy, but maybe because of hyper competition, the business that we are backing is now showing poor quality. So if any one of these parameters is not, continuing to remain checked anymore, we would exit. So I told you that our portfolio is constructed at the intersection of both quality and growth. We want both parameters. If any one of them gets unchecked, we would exit.
But Mr. Tyagi, you focus mostly on the growth and the quality. But stocks like Jubilant Foodworks, Avenue Supermart, and Info Edge are there in the portfolio, and the market refers to them as a BAAP stocks, like buy at any price, because they are justifiably at the very high levels, and which makes it slightly risky. So doesn't it scare you to invest in such high PE stocks?
Yeah, that's a good question again, Chirag. In fact, I had written a blog on the same maybe about 7 or 8 months back. And the intention of writing that blog was to actually explain what goes into a price earnings multiple. You see, a price earnings multiple is nothing but shorthand for the discounted cash flow analysis or the intrinsic value analysis that we guys do. If you just dissect the price earnings multiple, what you finally get are 3 factors: return on equity, cost of capital, or you can even call it cost of equity, and growth. For a minute, assume that cost of equity is constant across all sectors and all companies in India. Actually, it is not. The cost of equity for a Nestle would be lower than the cost of equity for a DLF. And a lower cost of equity itself means that the price earnings multiple has to be higher. But for simplicity, let's just say that the price earnings multiple is a derivative of only 2 factors: return on equity and growth. Now, the fact is that a business generating 10% return on equity versus a business generating 50% return on equity would have a massive difference in terms of price earnings multiple, because a higher return on equity means higher cash flow generation or high cash conversion. For each unit of profit, you have a very high cash flow generation. And as we all know, intrinsic value is nothing but discounted value of future cash flows. If these cash flows are indeed very high, your intrinsic value will keep on increasing. The price that you would, if intrinsic value increases, the price that you are ready to pay per unit of earnings would obviously be very high. So think of it like this. On one end, you have Nestle, a business which generates 100% return on equity. On the other hand, you have a Tata Steel business which generates 10% return on equity. Both have very, very different cash flows. Even if both earn theoretically 100 crores of profits, the cash flows in both will be very different. Nestle would have 100 crore cash flow for 100 crores of profits, and this cash flow will keep growing every year. Tata Steel would have some years positive cash flow, some years negative cash flow, and on an average, very poor cash conversion anyway. So the price that you should be willing to pay to a business like Nestle would be many times over that of Tata Steel. If you're giving a multiple of 10 to Tata Steel, you should be happy giving a multiple of 50 to Nestle because of this massive cash flow generation every year. The second factor is growth. If you find a business which is showing secular growth, which keeps compounding at 13, 14% every year, that business obviously should trade at a multiple much higher than a business which is just growing at 7, 8% every year. I mean, you people are champions in compounding. Just try and compound 15% over 20 years versus 8 or 9% over 20 years, and you'll get an answer. The problem is price earnings multiple only looks at the next year, at best next 2 years. It misses out on the compounding. So when you're valuing a great business with great growth potential, you're only trying to value by basis of PE, you're only trying to value its next year's earnings and maybe earnings 2 years down the line. you are unable to capture the compounding of these earnings 5 years, 10 years, 15 years down the line. And that creates a huge difference. So the operative thing here again is the same. Where would you lose money? You would lose money in these stocks when either of these two things get unchecked, either the quality or the growth. Quality gets unchecked means that ROE falls. There would be a massive derating. Growth gets unchecked. It means that the compounding will stop. The P will get derated. So long as ROEs and growth rates remain stable, remain strong, a business which has remained expensive for the last 20 years can continue to remain expensive for the next 20 years. There are many such companies. It's very easy for you to just look at them and realize how they have justifiably remained expensive and still created strong returns for investors.
So how much do the current market valuations worry you? I'm asking you because the PE ratio of the flexicap fund is around 40, and which is mostly higher among its peers. So how much current valuations worry you?
So let me answer this question in two ways. While our portfolio is expensive, let me say that it has always been expensive over the last 10 years. It's almost like saying that, does it worry you that Kotak trades at 2.5 times price to book, whereas SBI is trading at 1 time price to book? So the difference is 2.5 times. Do you worry that Kotak will get derated further, or maybe SBI will get re-rated further? By the way, SBI is the most expensive public sector bank. Maybe a Punjab National Bank trades at a fraction of SBI itself. So again, use the same framework. Price to book value of Kotak versus SBI is decided by the ROEs and ROAs of Kotak and the long-term growth rate of Kotak. So long as these are materially better, Kotak will trade at a higher valuation. And I just want to extrapolate this thought process to our portfolio, which is that so long as we are buying a Maruti and not buying Tata Motors, so long as we are buying a Bajaj Finance and not buying a PNB Housing Finance, so long as we are buying a Kotak and not buying SBI, we will remain expensive. So long as we are buying a LTI Mindtree and not buying a Tech Mahindra, we will remain expensive because these businesses are the best in class with the most steady outcomes, with the most resilient balance sheets and cash flow generations. They will never be cheap. So if you look at our portfolio over the last 10 years, we've always traded at a premium to the market. Since your question was high valuations worry you, I would say because in the last 3 years, quality has not done as well and the value part of the market has done very well. We have actually become cheaper compared to our long-term average. So today, quality is indeed cheap, and because of quality being cheap, a fund like UTI FlexiCap is actually trading at lower than average valuations, which is giving us comfort rather than being worried about.
Sir, but given the scenario, given the strategy and the framework which you follow, like high growth and the high quality companies, there has been a scenario where in the last 1 year, the good quality companies have not worked well, as you said, like value theme has done well in the market. So how do you then deal with the stocks which have not done well for the 1 year and 3 year period?
So we deal with this situation by segregating the price movement of the stocks from the business move. We remain focused on the business. Price is something which is beyond our control. And I'm sure you're not for a minute saying that markets are efficient. Therefore, whatever the price the company is trading at is the true price, and there is never any mispricing in the markets and everything gets priced in efficiently. We all know that's never the case. Markets have their own predilections, their own favorite sectors from time to time, and the favorite sectors keep rotating. What we wish to do is stay very constant and calm when such a thing is happening and remain focused on the business outcome. So what we keep evaluating every quarter, every 6 months is our hypothesis still alive? Is the quality and growth vector, the two vectors that we cherish a lot, are they still getting checked? If that's the case, we just move on. The markets may not be rewarding private sector banks today. They're maybe rewarding PSU banks today, but that's okay. If the outcomes of these private sector banks still continue to be as solid as they have been, you must be happy because you are finding them to be cheap today, which means that the prospective returns could be very, very high. So we just try to segregate the price behavior from the business behavior. Yeah.
Okay. So how do you want to bring the glory back to the UTI flexicap fund? The fund has seen some underperformance in the recently. So what's your plan on the bringing the glory back to the flexicap fund?
I think the glory will come back only if we remain patient and don't act irrational. And it goes back to the previous question that you had asked. So if I try to act on things, if I try to just feel extremely frustrated about the fact that the performance hasn't been good and therefore, our rankings are going down, I would start committing mistakes. So, we've all heard about these stories about, a great sportsman is the one who doesn't look at the scoreboard, only focuses on his game. Because if you start looking at the scoreboard, you become nervous and you then start to, doing stupid things and not focusing on the game. Same is the case with fund managers. If you start looking at your scoreboard, if you start looking at your rankings, if that is something which is giving you anxiety, then you would end up making mistakes. I started the discussion by saying that, we are really patient long-term investors. We don't move the portfolio around too much. We've seen these phases of value outperformances at least thrice in the last 15 years. I can recollect 2010 was a period when quality massively underperformed value. 2017 was another period when quality massively underperformed value. And 2022 has been another such phase. We always come out victorious out of these phases. And using your own words, we bring glory back to our fund by just thinking long term, not doing irrational things, not looking at the scoreboard and just focusing on our game. We don't have to worry too much about our companies. They will take care of themselves. We have to take care of our emotions. So I have to insulate the portfolio from my emotions. My companies know how to take care of themselves. They are sector leaders. They are the champions in their respective sectors. They are the best of breed companies. They would find, more and more avenues to grow their business and grow it profitably. Yeah.
How closely do you work with your CIO? Is there kind of guidance or a hand holding that he does for you and as well as for the team?
Absolutely. The role of CIO is to handhold the entire team. As head of equity, I report into the CIO. So we have discussions pretty much every other day on a variety of issues. We also have a very strong framework of monitoring, analyzing, and having a discussion with each of our fund managers. We do that. It's called the portfolio review. We do that every quarter, in which we try and review we indeed review the portfolio of all of our portfolio managers. That meeting is headed by our CIO, and I join him for those reviews. And in turn, I also get reviewed by the CIO for the quality growth strategy or the flexicap fund that we have just discussed. So, he's playing the role of, if I can use the word from Mahabharat, the Bhishma Pitama in our firm. He doesn't manage money anymore, but he's the one who's been, having a very close oversight over all of our strategies. I must put the record straight here. We don't interfere with the portfolios of our respective fund managers. We give them amazing amount of freedom. We never guide them, buy this or sell that. We just devise a structure in place. We want our portfolio managers to be true to style. We want our fund managers to be always within those side rails, and that's what we do in the fund review and the monitoring process as well. Yeah.
All right, Ajay, before we wrap it up, one more question. In this over 2-decade-long career of yours, can you recall an investment decision of yours which you're really proud of, and probably another one that you regret?
Ruchira, I don't mind calling out names here, but you would agree with me, it becomes unfair for people like us to take out names and talk ill about companies. So especially because this interview could be watched by many people. So I don't want to take names here, but I certainly want to share my learnings.
Right.
And my learnings, actually, my biggest learnings, if I talk about what I'm proud of today, is in a way, the question that Chirag said, do you have a price target? Not having a price target, to my mind, has been the most proud, part of the philosophy that I've ever had. Because I would have missed out on these gems, and I would have thrown them out, very, very early on in their entire life cycle of wealth creation, if I had an exit price in mind. So what I learned very early on, of course, I did make mistakes early on. What I did learn very early on is that, while there can be a stop loss, there should never be a stop profit. If there is a business which is doing well, and if that business has been, kind of surprising you with the amazing execution that it has been showing, then why exit? And it shouldn't be very difficult for you or the others watching this interview, that if you really don't have a stop profit when it comes to equity markets in general, if we guide our investors that, look, equity is a long-term asset class, be patient with it, make systematic investments, don't try to time the market, don't try to make lump sum investments when you feel that the last 5 years have been great and extra, and you may be perhaps extrapolating it. At the same time, don't exit the markets just when you feel that markets are not doing well, or maybe you feel that your money has already grown 2x, therefore you need to exit. Likewise is the case for businesses. If something is doing well, why actually come out of it? So I think that's if you ask me, when I look at some of my portfolio holdings, I just feel proud about the fact that I just focused on the business, never focused on their price one way or the other, never felt frustrated when the price came down and exited. Equally, never felt as if the big money has been made because the stock has gone up 3x, 4x, and therefore I should be exiting it. So that's on what I feel happy about. What I feel sad about is, in certain cases, I didn't do my research too well. So there have been many companies in which I've gone wrong. In a long career, it's only bound to happen. Even if I'm very selective in terms of choosing my company, even if the portfolio turnover ratio is low, but I would still say I've gone wrong in multiple companies over the last decade and a half that I've been, a fund manager, and even prior to that as an analyst. And I just realized that maybe I was in a hurry. Maybe I was just too excited about the big story that the markets were creating about it. And maybe I just felt that if I don't pull the trigger now, it may be too late. But the learning was that for great businesses, even if you take a couple of years extra, you're not too late, because the compounding happens over decades. So take your time, be patient, take your time before entering, and just try and go deep into it. Never ever have a compromised research process. If there are 10 boxes in the research process that need to be checked, including speaking to competitors, including speaking to some of the customers, please do that, and don't just jump to a conclusion because you're feeling the pressure and you're feeling the pressure of missing out. Yeah.
Fair enough. On that note, we'll wrap up this chat. Thank you, Ajay. Thank you for taking time out for this discussion. And we hope our viewers benefit from the insights that you've shared. Thanks.
Lovely. Thank you, Ruchira. Thank you, Chirag, for your very deep and insightful questions. I enjoyed the interview. Thank you.
Thanks.